Hi, this is James Shug with Westpac London's end of day report for Thursday, the Ides of March, the 15th of March. Positive day on European equity markets, not so much so on the London market. Rumblings by Fitch that they might be inclined to strip the UK of its top grade credit rating seem to have had a weighing down impact on the UK market. Although the market did subsequently respond positively to the reasonably decent US economic data that came out, which meant that by the end of the London session, the FTSE was actually pretty much unchanged, down 0.08%. The strong data actually that I referred to were the New York and Philadelphia Fed factory indices. Both of them had stronger headlines. Drilling a bit deeper though, the detail wasn't quite so flash. Both of them showed slower growth in orders and shipments. In fact, in the case of the Philadelphia Fed survey, we saw declines from 11 or 15, so double-digit Feb readings, to around 3 in March for both orders and shipments. So quite a big pullback there. Both of those surveys, however, did have stronger jobs readings. You've got to remember that the headline is a separate question on how businessmen feel about general business conditions, and it's not a composite of the detail. But if the April headline were to sort of correct down towards where the detail kind of implied a composite would be, then that could be an early sign that the recent positive momentum in the US economy might be stalling a little bit. And also the fact that the detail was softer could be an indication that the March ISM manufacturing survey could be perhaps a bit softer than we might have otherwise expected. So good looking numbers on the surface, and the market certainly reacted positively to them, but there's just a couple of questions about the detail there. Also in the US, we had producer prices for February, 0.4% gain, mainly driven by energy. Food prices was down a bit, core was up 0.2, not really a market mover. What was a market mover was the latest initial jobless claims report. It showed a 14,000 fall to 351,000. That matches the recent low that we saw a couple of weeks ago. Prior to that, you have to go back to 2008 to see claims around this level. So, that's a further confirmation that, certainly that firms are laying off fewer workers, but it's further evidence too that there might be a greater degree of sustainability to the recent run of better jobs numbers in the US than we saw during previous bouts of jobs market strength in 2010 and again in early 2011. Those job market booms subsequently died. This one looks like it could have a bit more legs than those two. We also had capital inflow data for the US, the tick data, which showed the first three big figure, well, the first net inflow for long-term flows over 100 billion since 2010. These are figures for January, when there was still quite an element of risk aversion about, I think, in relation to Europe. It took a while for markets to cotton on that what the ECB did in late December was effectively quantitative easing. And so there was still a lot of nervousness about Europe in January, and that seems to be one factor that have pushed investors into the safe haven of US Treasuries. I suspect figures for subsequent months will show you might see outflows out of the US, or certainly weaker inflows. And that's about it really in terms of the data today. I mentioned the FTSE pretty much unchanged. The French market up 0.4% at the close. The Germans up 0.9%. And at about 5:15 London time, the Dow in the US is up 0.33% at 13,239. Obviously benefiting from the jobless claims and those business surveys that I mentioned. Commodities are mostly higher, with the exception of oil, just down 0.2% today at $105.20 a barrel. And that's actually one factor that also weighed against the UK market, given the concentration of energy firms like BP domiciled here. But other commodities, gold up 0.9% today at $1,658 an ounce. Copper prices up 1.4%. And the Aussie dollar, I just want to, what's the Aussie at the moment? 1.05? 1.0542. So it's been rising through the London session in line with the positive equity market sentiment in the US and most of Europe, and with commodity prices pushing higher too, and generally risk aversion diminishing a little bit more. In fact, we've seen, I think, for the Dow, it's the longest rally we've seen in over a year now. So we're certainly very much seeing a period of renewed optimism about the US economy, less pessimism about Europe, but let's just see how long it lasts. Okay, I'll be back with more tomorrow.